All right. So, yeah, in the next 10 minutes, I will be talking about two topics, implementation challenges of Pillar 2 and a possible solution. And the second topic is how OECD has tried to theoretically achieve a balanced outcome for developed and developing countries. In the second topic, I have some data which would substantiate my opinion. But let's look at and start with the first topic. One of the most striking feature of the Pillar 2 is a sheer volume of computational complexity it imposes on the taxpayer. Let us first understand what these computational complexities are and then talk about a possible solution for it. Under the Pillar 2, the first step to compute or to identify whether the Globe A rule is applicable or not is to identify whether a jurisdiction is undertaxed. And to do that, you need to compute effective tax rate of a particular jurisdiction. And then compare that with the global minimum tax rate of 15%. If it is less than the 15%, ETR is less than the 15% minimum tax rate, then that jurisdiction would be under tax jurisdiction. Now, OECD under Pillar 2 has prescribed a method or a mechanism for computing a jurisdictional effective tax rate. The formula for which is adjusted covered taxes on a jurisdiction basis to globe income or globe income. While this formula looks quite straightforward, but it requires more than 30 adjustments. Some of it are like tax to book to tax adjustments, like timing differences. And some are some adjustments specifically designed to factor or exclude like shipping income from the globe income. So almost like more than 30 adjustments to be made to numerator and denominator in the formula taken together. This is going to be quite mammoth exercise. Consider a situation where a multinational group has 50 subsidiaries across 50 jurisdictions. In that case, a multinational would have to compute or identify 1,500 data points, which is 30 adjustment points into 50 jurisdictions to compute and determine the first step whether a particular jurisdiction is under tax. This is going to be quite burdensome administrative burden for the multinational. So what's the solution for this? A simplified approach is something which could ease the administrative burden of the taxpayer and tax administration. One of the simplification measures is a country-by-country ETR safe harbor. This was discussed by OECD in the Pillar 2 blueprint, which was released in October 2020. Before we get into what this CbCR ETR safe harbor is, let me just quickly talk about what CbCR filing is for the benefit of everyone in the audience. Under CbCR, large multinationals having turnover consolidated revenue of 750 million euro are required to file annually country by country reporting. It's also called a CbCR in a short. This CbCR filing has certain financial data points. Out of all these financial data points that are reported in CbCR, two data points are quite relevant. First is the income tax accrued in the current year, and the second is profit or a loss before taxes. With these two data points, a simplified jurisdictional ETR can be computed by leveraging on the data which is existing and available with the taxpayer. Under the CbCR ETR safe harbor, if a jurisdiction's effective tax rate, the simplified tax rate, ETR computed using the CBC data, is above a certain threshold, then no further work would be required for that jurisdiction under the Pillar 2 global. So right now, before going into this, like this safe harbor rule is still a work in progress. It is expected to be released by end of this year. And being a safe harbor, naturally, the threshold would be higher than the minimum global tax rate of 15%. Right now, we do not know what exactly that would be, but it would be anytime higher than what is there in the global. So let's take an example. where OECD comes up with a safe harbor of 20% threshold, ETR threshold, using CbCR. It means that all the jurisdictions where the multinational has its presence, and if that jurisdiction has an effective effective tax rate using the simplified formula which OECD would prescribe using the CbCR data, if it is about 20%, then no further work would be required for that jurisdiction. So in our example, if the 50 jurisdictions, out of that, if 30 jurisdictions have ETR, simplified ETR of more than 20%, then those 30 jurisdictions are outside the scope of globe rules. This would ease the administrative burden of the taxpayer significantly and also would reduce the administrative burden of the tax authority. So CbCR safe harbor is quite a pragmatic solution, but how do you compute this using your CbCR data? While the CbCR data is there, most of the multinationals prepare it in Excel, and Excel could be quite handy to compute this simplified ETR, but there are certain tools available in the market. You can use certain tools for computing your filing of CbCR, doing analytics, and also identifying the effective tax rate for each jurisdiction. Like at IBERIA, we have developed a technology which helps multinational file CbCR, undertake analytics, and also compute the ETR across all jurisdictions. Let me just show it to you how it looks like. But this is like quite a simplified version of it. So yeah, it should appear in a minute. Okay, while it's uploading, the point that I wanted to make over here is there is a need for this simplified approach. And CbCR data could be a very handy information because it's already available with the taxpayer. And most of the taxpayers who would be doing CbCR would be covered under the globe rule as well, because the threshold of 750 million is common across the CbCR filing requirement and also in the globe rule under pillar. So this could be a quite pragmatic solution, which OECD should further consider and develop a safe harbor related. This was the first part of the topic that I wanted to discuss. In my second session, or in the second topic, I will be discussing about how OECD has tried to achieve a balanced outcome or a harmonized outcome for developed and developing economies. For this, I have taken some data which I will be presenting to you shortly. When you look at the overall design of Pillar 2, there are two parts to it. There's a globe and then there is subject to tax rule, STPR. Let us first talk about the globe rule. When you look at this rule, particularly the income inclusion rule under the globe rule, it is designed to benefit the jurisdiction where the ultimate parent entity of the multinational group is located. And most of the large multinationals, which have which cross the 750 million threshold, have the parent entity in developed economies. Let me substantiate this point with some data. There are around 6,263 multinational groups that could be covered under the scope of global. This data is extracted from BBD database by applying a 750 million threshold. Now, what I did, I've split this entities or 6,263 multinationals and bucketed them under three baskets. Developed economies, almost 65% of the parent entities of these 6,000 odd entities are in developed economies. 21% is in China, which is somewhere in between developed and developing economy. And only 14% is in developing. So this data, with this data, we can understand that there's not much upside of the Pillar 2 globe rule for developing economy. It's only like at a macro level, only 14% of the developing economies have parent entity. At the same time, there is a much downside of the globe rule to pillar to globe rule doesn't have much downside for the developing economy. I will talk about this with some another set of data points. Before I discuss this data point, let me talk about what this data is. This is the statutory tax rate across developing economies. And most of the developing economies have a very high statutory tax rate, corporate tax rate. Now, out of 137 member firms, like member countries, OECD, G20, and inclusive framework member countries, statutory tax rate data for 128 member countries was available. Out of those 120 member countries, 66 qualify as a developing economy as per the OECD's definition of developed and developing economy. Of this 66, almost 32 have tax rate above 30%. Another 32% developing economies have tax rate between 25 to 30%. And 18% have tax rate between 20 to 25%. When I'm referring over here to the statutory tax rate, it's not an effective tax rate, nor I have taken into consideration any specific tax exemption or a concessional tax rate that are operational in certain jurisdictions. So at a macro level, when you look out of these 66 jurisdictions, almost 82% have tax rate above 20%. Well, this cannot be a conclusion that the effective tax rate will be more than 15%, but at least some inference could be drawn by analyzing these two data points that at least it could be safe assumption to say that the effective tax rate with such a high statutory tax rates could be equal to or more than 15%. That's an inference that is being drawn. It's not a conclusion that I'm. So with this, there isn't much downside of it as the tax rates in the developing economies is already high. So they would rarely come into a situation where they would have to shift their taxing rights to developed economies. At the same time, there is always this domestic minimum, qualified domestic minimum top-up tax mechanism available to be implemented in these jurisdictions to prevent shifting of the taxing. So to sum up, when it comes to the globe rule, there is not much downside, nor there is upside. It's quite a neutral outcome for a developing economy. At the same time, there is the second part of the pillar two, which is subject to tax rule. And STTR empowers the sourcing jurisdiction to charge a minimum tax rate of 9% on certain categories of related parties, like royalty, interest on loan or finances, and there are other risks of such payments. So when you look at how the developed and developing economies are structured, most of the developing economies are subsidiary jurisdictions, which imports the technology and pays out royalty. They get the loan finance from the group company and pay out interest. So with this subject to tax rule, developing economies can impose a minimum tax rate of 9% on these payments made to the related entity. So this is something of a value for developing economy. So overall, to sum up the entire analysis, while the globe E rule would have like a neutral outcome for developing economies, but the subject to tax rule is something which could be of a value to a developing economy. Here, I would want to make a point of a caution, like globe, globe rule or pillar two would have certain implications which are beyond taxes. For instance, impact on the foreign direct investment for the developing economy. And this is something which is not known yet. But one can, at least from a tax point of view and in theory, by looking at these two data points, one can safely, or I would say, draw some inference to come to a conclusion that globe E rule may have a neutral outcome. STTR would be beneficial, and hence there is a harmonized outcome for both developed and developed. But this is theory. In practice, how it turns out to be, no one knows. We need to wait and see how the outcome looks like when we actually implement it. So this is what I wanted to come have it discussed in this session. Happy to address any questions that you have, and over to you, Manoj.